Everything goes from overvalued to undervalued to overvalued to undervalued. And they picked what had been the most overvalued time in history to start this measurement. So the way this is phrased, it's true, but the intention is, gold was $400 an ounce in November of 79. And by January, it was 850 at a close, 873 intraday. And so at that, it did go down to 250 by the year 2000. But yes, it was overvalued compared to the currency supply, compared to real estate, compared to the stock market. Gold was in a bubble, but they picked the peak of the bubble to start this measurement here. Pick the date of the actual high. January 1980. You didn't put in January there. If you can do this with anything that goes through cycles. You pick the previous high, and then it takes years. I think we did in the book an inflation-adjusted S&P 500, and the crash of the NASDAQ. The NASDAQ took a long time, but even the S&P took more than 13 years to get back to its high. This is 27 years, and we are coming off of historic lows. Now, if you had bought in the first half of that bull market, when if you bought, gold went up from 35 to 200, and then did a pullback to 103 from 70, the first day of 1975. For the next 14 or 16 months, it fell 16 months, I believe, to 103. So if you had bought in there, you would still look brilliant because you were in profit the whole time, even if you didn't buy at 35. If you bought at 150, at 180, at 190, you were brilliant, and you're still brilliant even with that. But the thing is,
gold's most famous rally culminated in January 1980 when prices briefly touched $873 an ounce, nearly 25 times its early 1970s level. But this spectacular rise was followed by a brutal correction, with gold dropping to $250 by 2000. Critics argue this decline proves gold's weakness. Yet context is critical. That 1980 spike was a bubble fueled by runaway inflation, geopolitical tension, and speculative mania. Measuring performance from the very peak misrepresents gold's role. A more balanced view shows gold remained a powerful hedge, especially when global currencies weakened or financial systems wavered.
Everything goes from overvalued to undervalued to overvalued to undervalued. And they picked what had been the most overvalued time in history to start this measurement. So the way this is phrased, it's true, but the intention is, gold was $400 an ounce in November of 79. And by January, it was 850 at a close, 873 intraday. And so at that, it did go down to 250 by the year 2000. But yes, it was overvalued compared to the currency supply, compared to real estate, compared to the stock market. Gold was in a bubble, but they picked the peak of the bubble to start this measurement here.
Gold doesn't just rise and fall randomly. It often follows inflationary trends with a lag. In the mid-1970s, inflation surged, and gold mirrored the movement months later. The same pattern has reappeared in recent decades. After 2015's low, gold tracked renewed inflation pressures, peaking above 2000 during the pandemic and beyond. Analysts note that if you shift historical inflation data 6 months forward, it closely aligns with gold's movements. Today, with sticky inflation, global debt expansion, and geopolitical uncertainty, gold's correlation to these forces suggests that the cycle is far from finished.
Here's another very interesting thing about this chart. The waves of inflation go along. There's a little bit of a lag time in the gold price. It was the first day of 1975 when gold did its turn. So through 74, it was rising, and then it did its turn and started falling in 75 into late 76. And then obviously it peaked in January of 1980. So this chart, if you take that blue inflation line and you shift it 6 months to a year, it tracks the gold price. That's very interesting. And yes, you are right. That red line. So this would be equivalent to buying, wow, where we are right now, if you shift it back 6 months, you're buying at the $103 low in 1976. That is where we are right now as far as if you want to compare these two bull markets. You're buying in the middle of, actually 2015 was the low in this cycle. We had a big dip back in 2015. But yeah, so anyway, very interesting.
Hindsight makes investing look simple. Buy the 1999 bottom at $250, sell at the 2011 high near Nothers, then buy back in 2015 when gold touched $1,050. But real investors don't have perfect foresight. Instead, long-term accumulation often proves more effective. One investor who steadily bought gold and silver since 2003 reports every purchase is profitable today despite multiple downturns. This reveals the strength of disciplined strategy. Timing peaks is almost impossible, but owning assets through cycles secures lasting value. The same applies to equities, which also alternate between under and overvaluation.
If you did a regression from 2015, it looks like about 2014, there's that big fall there. If you did a regression from 1950 to 2014, and then another one from 2014 to today, you'd get one line that's going up and another line that's going down. And so you can see it's been falling since 2007, that big peak there. 2007, the big peak, the $140 peak. Yeah, you can almost, so if you did a regressions, you'd see this. It is very dissimilar. If we have, everybody's got 20/20 hindsight. You can see it perfectly clear that 2011 was the high, and that's when you should have sold. You should have bought right down in 1999, 2001 at that $250 double bottom. And you should have sold in 2011. And then you should have repurchased in at the end of 2015, beginning of 2016, and then you would be a genius.
Well, duh.
You know what? I'm very happy with my purchase. I started in 2003. I've been accumulating. And my silver, silver is above all purchases that I've made are in profit over the past, 20 years. I'm in profit. I don't have a single purchase that's underwater. And so I'm extremely happy. Now, if you compare this to the stock market, the stock market did the same things. And if you pick 1982 is when it was undervalued and you should have bought the stock market, and 2000 it was overvalued, and then it crashed and you should have bought in 2001, and then you should have sold in 2007, and then you should have bought again in 2012 or 13 whenever it bottomed. And no, actually it bottomed. It bottomed in March of 2009. And then, after the global financial crisis. And that's when you should have bought, March of 2009. So anyway, this guy's cherry picking and using a bunch of vagaries to try and prove his point. So this is all emotion based.
Critics often claim stocks always outperform gold. That depends on the timeline. From 1982 to 2000, equities massively outshined precious metals. Yet since 2000, the picture is very different. Gold has more than tripled the S&P 500's performance this century. It's not just about returns. Gold carries no counterparty risk. Companies can fail, management can collapse, And even mighty corporations can go bankrupt. But gold doesn't default. It has intrinsic permanence that no stock certificate can match. Investors balancing both assets often find resilience across crises, blending growth with security.
They picked the global financial crisis, 2008. Why didn't, you would think that if you were going to pick something, you don't pick the top, the peak of a gold market or a silver market. You would pick something in the economy. He just picked in Afghanistan was the previous thing versus Ukraine. And so if you pick the global financial crisis, well, fast forward to 2008 when you could have bought gold for $700. Changes this narrative completely, doesn't it? You probably haven't done it in this presentation, but for anybody out there that subscribes to stock charts, there's a feature that they have called perf charts, performance charts. You can put in 2, 3, 4 different stocks or indexes or items like gold, and you can compare them over different periods of time. And yes, there are periods of time where the stocks outperform gold, but if you go to this century, just start it off on January 2nd, because January 1st is not a trading day, January 2nd, 2020, and you cover this entire century, gold has outperformed the S&P 500 by triple. More than triple. It's way, way ahead of it. It makes stocks look like a really stupid investment. Yeah, everything goes in its waves and cycles. But this article is doing nothing but cherry picking.
Cherry picking data tells any story you want, but the truth is more complex. Gold has booms and busts just like stocks. Both can outperform, depending on when you measure. But gold's enduring role lies in what it represents: security, tangibility, and a safeguard against systemic risk. In times of crisis, from the 1970s oil shock to the 2008 financial meltdown to today's global uncertainty, gold has provided stability. Stocks may generate higher gains and expansions, but gold shines brightest when confidence falters. That balance, not selective snapshots, reveals the real story of wealth through cycles.
If you don't take the action at the exact same time that they do, you're not going to have the performance that they were able to achieve. But they achieved this, which is admirable. They did a great job, but they did that with things that are highly volatile. And here you have something with zero counterparty risk. You can hold it in your hand. These are all stock picks. So you're investing in a company that has a management team and has a whole bunch of other vulnerabilities that they can actually go broke. They can go to zero, and gold cannot go to zero. That's like, I suppose it could if humans became extinct. It would go to zero,
exactly.
Right?
Exactly.
No, humans,
stocks would go to zero too.
Gold. Huh?
But stocks would go to zero too.
Yes, right. And so would his 1,007% gains on the portfolio. That would go to zero as well.